First rates on your screen. We're getting the first rates on the Sensex and the Nifty, and on the Bank Nifty it's a red across the board for all the markets. But the breadth, I think, is looking phenomenally better than what it has looked in a long time. So you're off to a great breadth. 1:4, 1:5. That kind of a market breadth always gives a bull or the bulls a spring in the stride, so to speak, right at the open. Now what is really bouncing up on my screen, and I'm purely looking at the price action here, there is nothing meaningful, if I may say so. There is MMTC, which is up another 5%. There is a Easy Trip Planner up another 2%. There is Zomato. Well, you've got a comment already which has come from Swiggy, so Zomato is really racing to 112. Markets are getting now more and more convinced that the food delivery business, I think, is here to stay. Tata Motors, buy the rumor, sell the news. Well, the news is out. The rumor was there on Friday. Market reaction, no reaction whatsoever. Avenue Supermart. Okay, top line is coming back, but where are the margins? I mean, on this kind of base, if the margins are not there, the markets would say that, okay, it's a business where P contraction could happen rather than P expansion. State Bank of India just holding at 574. And Titagar, Tesmaco Rail, 8-9% up for Tesmaco Rail. So it is really moving in line with what the other fancied railway stocks are. Just that it has a lot to catch up in terms of where it stands versus where others have moved.
Well, yes, and what's also supporting the sentiment on Texmaco Rail is that strong result with 60% kind of growth on top line as well as bottom line, and the demerger happening and new green entities being created for green energy, etc. So all of that is supporting Texmaco. But of course, it's the banking names which are on back foot. So HDFC Bank is starting a bit somber ahead of its earnings. Indices Bank as well, after that run-up that we had seen on Friday, is consolidating a bit. So not a runaway rally, a 1% cut coming in there. IT, that's actually bouncing back sharply. So HCL Tech is one of your top performers at the index level, 1% gain. Infosys is doing all right. And then real estate continues to build on to gains. So Prestige, Brigade, these are some of the names which are doing okay. The interesting bit there on the screen is the advance decline ratio. Look at the NSE advances, 1420 versus the decline of 461. This is, of course, when Nifty, Sensex as well as Bank Nifty has started on the back foot. What's doing okay is NBCC, 4% higher on account of some order wins and tie-ups. Prestige, as I talked about. You also have names on the losing side. Delta Corp definitely deserves mention. 8% shaved off that stock. That stock has been under tremendous pressure of late. It's a 6,300 crore order that they have got for some tax, which is due for Delta Corp. So that stock is in focus. You also have DMart, which has slipped almost 4% now. And BPCL, Berger Paints, Asian Paints, some of these crude dependents, especially the paint names, are coming under pressure. Add to that list Apollo Tyres as well. There was one of the notes, but of course, the entire industry is a big user of crude. So all of these stocks are coming under pressure. So not a great start, but it's not too ugly as well. 19,700 at least is being held on for now.
Okay, broader market absolutely listless, by the way, at the current juncture. But let's find out what our chartists make of the market open. And as Anisha was saying, Kunal, it's really all in the advanced decline ratio. What do you make of that, and the fact that we're seeing some of the frontliners taking a back seat to the likes of Indices and HDFC Bank?
Yeah, I think it's more or less very similar, that the indices are consolidating because of the way the news flow is panning out across stocks. So I don't expect any major move on the indices, neither on the downside on the upside. 19,700 to 800 broadly has a very tight range for the day. Now in terms of stocks, Tata Motors is something which looks attractive, trading at 665 approximately on the spot levels. Would look out for trading the stock on the intraday basis and targets closer to 680 plus.
What about you, Naresh? What's the first trade that you are punching in?
So liking Power Grid as a defensive play, which could make a breakout move about 205 in the short term. So at 200, 201, the risk reward is good. The stop loss at 196, expecting a move to 220 plus.
Point taken. Before I let you go, actually, Kunal, a quick word on some of these paint names. Asian Paints as well as the other names are coming under pressure. Anything that you would look at adding positions onto?
Not really, Anisha. In fact, many of these stocks are actually looking weak in terms of the chart structure. Berger Paints very close towards a breakdown of the previous support of 550, so it's just 2 or 3% away from this major or critical support. Asian Paints has already confirmed a breakdown. It's managed to break below the 3200 mark, which has been a huge support for the stock over the last 3 months, 4 months. So I think that's also given a confirmation of a breakdown, which means Berger Paints can also follow very similar kind of a trend. So would not be bullish on the stock and on the set of stocks, and would probably be on a wait and watch.
Okay, just to reiterate, Kunal, that stance on the Nifty Bank as well, it continues to remain a hold, right? But what would change the view to a buy if some of the larger banks, the frontliners, participated?
So I think the best way to trade is wait out for this range to be broken out, because we are stuck into this. I think on the Bank Nifty around 1,400 point range for the Bank Nifty, 43,800 approximately as a support, and closer to 45,200 as a major resistance. So it's always best to wait out which side of the markets the Bank Nifty is breaking out or an index is breaking out. It's very difficult to anticipate whether HDFC Bank would lead from the front or IndusInd Bank or XYZ stock from the banking name. So I think I will stick to the levels over here: 45,200 on the upside, 43,800 on the downside.
Okay, so in the meantime, just a few more stocks that I want to highlight. Gokuldas Exports is higher by 8%. You also have Skipper, which had bagged some orders, so that stock is higher by 6%. MCX, which has started their new software, which has been in a long time in a limbo. Finally, it's out, so that stock is higher by around 3%. And for Gati as well, there was some update that we had got in terms of how their volumes have panned out. It was quite positive, so that stock too holding up with a gain of around 6%. But I think, Nikunj, we have Lawrence Blanco joining us in the show. A lot of technical factors to discuss in terms of where Nifty is headed.
Yep, Lawrence, always great to have you back on ET Now. Thank you for joining us. Lawrence, if I look at the world right now, equities as an asset class is at a multi-month high. Now, while other markets are in and around the 52-week high, India is the only big market which is at a lifetime high. So where does India go? It has already hit a lifetime high already a couple of weeks ago.
Yeah, I mean, the Indian trend from a longer term side, if you look at the Nifty, that breakout that you had early in the year around June when you got above the 19,000 area was significant, and we still got longer term targets of 22,800. In the near term, we have seen some slowing upside, which does suggest that we go through some kind of consolidation period. But ultimately, this consolidation pattern or sideways range that we get over the coming weeks should set the platform for the continuation of that original breakout and a move up towards that 22,800 mark.
So what is your 1 year price target for the Nifty, and what to your mind could be the bull case and the bear case?
Yeah, so we don't carry 12-month targets because we rely on the price action from the chart. So the breakout that we saw in July when we moved through that 19,000 area still gives us that 22,800 upside target. It doesn't give us a time horizon that we get within that, but that is the target that we focused on from that breakout. If I look at the very near term, we're consolidating above 19,100, 19,200, which is basically the bottom end of the range, to 20,200. So those are the more immediate levels to pay attention to within that original breakout that we've seen earlier.
Lawrence, do you see Indian markets outperforming the global market like they've done in last 12 to 18 months?
Well, I mean, I think it's quite interesting because if you put the Indian market in dollar terms, it doesn't look as significant as if you look at it in local currency terms and then on a relative basis. But I think the key message from the longer term side is India, both in relative terms on a dollar basis, is in a longer term uptrend, as well as if you look at it in local currency terms. And I think it's about adding through these corrective phases that, in the short term that we currently see. So that longer term trend we think is intact and should sustain itself. And it's really about picking spots where to add new long positions.
But Lawrence, what do you make of this divergence in terms of the outperformance when it comes to the mid-cap and small-cap space versus the large caps which have been underperforming? Would you say it's getting a lot more frothy as far as the mid-cap world is concerned?
Yeah, absolutely. I mean, we had a great breakout in June, and the mid-cap index actually hit the upside target through early September. It's quite interesting that if you look at the 20-day moving average, had been a great guide for that accelerated trend in the mid-cap index. And then by mid-September, we started to test that 20-day moving average again. 2 weeks ago, we broke below it, and now we've seen some choppy volatility around it. So I do think there's corrective action in that mid-cap side as we consolidate. And I do think we've got some relative underperformance for the mid-cap space over the coming weeks. Longer term, though, anything closer to the 50-day moving average, you can re-look at engaging with the mid-cap index. But where it sits right now, we think that's in a corrective phase, and it's likely to underperform the Nifty itself in the short term.
Lawrence, morning. Just earlier, we were debating what's really going to lead the Nifty Bank Index, if at all we do see a breakout. And a lot of the large caps haven't quite been performing. So, do you think that what is going to lead to the breakout in the Nifty Bank is going to be the participation of some of these frontline names, or largely the fact that it's just been in a tight range and you need to see some sort of a decisive move on the upside?
Yeah, I mean, I think we're looking for a decisive move, but if I had to take a step back and see, what is the key driver for the banking sector from a longer term perspective, it's worth noting that the public sector banks are based out relative to the private sector banks just over 18 months ago. And that significant re-rating, we think, still lies ahead. So if we're looking at on a multi-month basis, we think that the public sector banks is still where you get more significant leadership within the broader banks sector, and that's a place that we'd continue to focus on to add to longer positions. State Bank of India is the biggest weighting within that. You've had a longer term breakout 18 months ago. You're currently in a consolidation pattern. I think ultimately that sort of leads and drags the broader banks index with it, but public sector banks is the key overweight position on the broader banks exposure.
Okay, so banking is of course one space that you like, but off late, Lawrence, there's a big rally which is underway when it comes to the real estate stock. Is that a space that you track closely? And if yes, any stocks that stand out?
Yeah, I mean, DLF, you'd have to take away in a similar fashion to State Bank of India, had done nothing for roughly 8 years, broke out of a trading range 18 months ago. Most recently, it broke out of another 12-month consolidation pattern, and that's a real sort of stand of leadership coming through within the property space, and again should continue to be one of the leadership stocks within the property sector.
Lawrence, within Indian markets, where are you convinced that a multi-year bull market cycle is started? Is it banks? Is it real estate? Is it PSU and defense? Where do you think that, based on the charts today, these are just early days? And if you catch them now also, you're pretty much buying them at the beginning of their multi-year cycle.
So, I mean, banks have been a key leader for some time. And you can even go back post the GFC lows, been back in 2008, 2009, and banks have been a key driver to that. More recently, you've seen the infrastructure and property sectors break out. So I still think banks are going to be a key driver. Obviously, just their weighting within the index. But the more fresh breakouts from that structural consolidation does come from infrastructure and property.
Okay, and Lawrence, I was just going through one of the latest note of yours wherein you are recommending to take some profits in India, and some of the names that you highlight include Power Finance and IDFC First Bank. Any other names that come to mind as profit booking candidates?
Yeah, so I mean, it really comes out from that mid-cap space where we see the short term really extended and where you want to take profits and then reassess through the corrective phase. Those would be two of the names that really sort of stood out to us where you want to be reducing some exposure. You've got Max Healthcare on the healthcare side. You've got MRF on the industrial side. So a few of those names, having been leadership, are now in a corrective pause phase that I think you can rotate into some of the laggards, which is essentially coming from the RT space, which had been a big underperformer last year, and you're starting to see some improvements there.
Which names specifically in IT, Lawrence?
Well, I think L&T Technology, LT Lantry is another one. Persistence is another name with high momentum, where I think you can rotate into and benefit from relative outperformance going forward.
The view on auto, and in particular the kind of breakout that we witnessed last year for the likes of an M&M. What's the view on Tata Motors in terms of the kind of trading range that it's been holding on to?
Look, I mean, autos have been one of the leadership groups early in the year. You've got a bit of dispersion going on in the performance of the stocks. For example, Maruti Suzuki's broken out with Hero Honda. So those two look interesting to be adding here. But if you look at Mahindra, for example, you've got slowing upside momentum, and that would be more of a take profit candidate. And Tata Motors is in a trading range currently. So be more selective in auto is the message that we would give, looking at the underlying stocks within the sector, and a bit of a pause at the broader sector level, having been a leadership sector early in the year.
There are a lot of sectors which have gone through multi-year consolidation, and one of them is consumer staples, HUL, to some extent Asian Paints, Pidilite, Tata Consumer. Is that sector getting ready for a big move?
From what we're looking at, no, we don't think that'll be a leadership side, and in fact think stocks are more likely to remain range bound within the staples. There'll be one or two that are improving, but in general, it's a space that I'd be sort of at weight or marginally underweight going forward.
Recent bounce in large cap IT stocks in India, is that a bear market? Is that a flash in the pan, more like a dead cat bounce, or IT in a sense has bottomed out?
So I think IT is bottoming out, but I think this is more of a tactical trade as you get a pause in the mid-cap and banking side, which is, I think, are key leaders longer term. I think you're getting some rotation into the lagging stocks within the IT sector. And you also got to bear in mind, at this time of the year, the seasonals are quite interesting in that there is a general tendencies for people to take profits in their winners as you get close to the calendar year end and allocate to some of the underperforming stocks, which sit particularly in relative terms when you look at the IT space. So I think that's more tactical rather than a structural longer term thematic.
Lawrence, you talked about SBI, but the entire PSU banking space, do you see a bit of reversal in place? Because of late we have seen quite a bit of profit booking there. Would you call it a bit of reversal, or is just consolidation and then we'll see another leg up? What's your view on the PSU banking basket as a whole?
So definitely think longer term leadership currently, like the Nifty, as we mentioned in our report, take profits of consolidation, same as the NSE banks, you're in this consolidation corrective phase. So we think that's more of the tactical pause and correction, but longer term, that's still where you're going to get leadership at the end of the day.
Next couple of months, what is your view on the volatility index, the global volatility index, given that geopolitical tensions in Middle East are surfacing up again? Do you think we could be in a stage of heightened volatility?
Yes, I mean, we look at the VIX, which is not the global volatility index. It's based off the S&P 500. And where we see this sort of consolidating is around that 20 area. So it will be slightly elevated to what we normally see in a bull market, which is basically around that 10 to 15 area. And while we think it stays elevated around 20s, if you actually look at the performance of sectors, not only in the US, but globally, there's significant dispersion going on beneath the surface. So in the US, if you look at an index of the top seven stocks, it's in a clear uptrend. If you look at the Russell 2000 of the small cap stocks, you're basically approaching the October 2022 low. So you've got this massive dispersion. So the part of the market's in this sort of low volatility grinding uptrend, while the more volatile, more speculative shares are in downtrends and highly volatile. And that's why I think on average that VIX will be around the 20 area and be elevated to what you would typically see in a bull market of between 10 and 15.
Okay, Lawrence, on that note, we'll let you go. Appreciate you making time for ET now, but shifting focus to what else is happening in the market. Well, we are doing okay. It's not a big slide that we are seeing at the index level right now. At least 19,700 thereabouts is where we are settling at the moment. It's Tata Motors, which has gained almost 1.25%. ONGC, HCL Tech, these are some of other gainers, while Nestle, Asian Paints, Divi's Lab are on the back foot. But one stock which has done quite okay, at least for this year on a whole, and I'm talking about Som Distilleries, it's in focus on account of earnings that the companies have delivered. Let's get on board Mr. J.K. Arora, the chairman at Som Distilleries and Breweries, to talk to us about just that. Mr. Arora, hi, good morning. First up, let's begin by discussing your operating performance, because the margins have slipped 80 basis points on a year-on-year basis. Even if I look at sequentially, it's down 150 bips. What explains the pressure when it comes to the margins?
Yeah, good morning to you. Margins have got really some pressure because of the costings and all, but because of the scale, we have done extremely well in this quarter also. This quarter is generally a weak quarter in the beverage sector, because you have Shravan, you have rains, you have many things in this quarter, but we have done exceptionally well in the very good quarter of the first, where we had the 51% growth. In this quarter, we had the 67% growth on overall. So I believe company has done extremely well in this, so that the margin pressures have tackled up to some extent, but more or less our profits, our EBITDA, PAT, all are in the line of the almost doubled the last year. So we believe it's a big achievement for the company.
No, sure, Mr. Arora, point taken on the top line, but margins, you talked about some cost pressures. You expect it to continue for the next few quarters, or are we likely to see at least some improvement in Q3, Q4?
Yes, of course, because as I said, this Q2 is generally weak in the whole year. But since we have done well and against the normal good growth of 51%, we have done 67%. So Q3 is also we are hoping for the good. Because everywhere the company market share is growing, so we hope to have the very good, especially Q4 is going to be a very, very good. Q3 is also I believe we will do well, as we apparently see growth of the company. We do not have any doubt.
So what is the realistic long-term margin trajectory according to you? Is it 13%? Is it 14%? Is it above 15%?
You see, because of the taxation at every point, now the government is taxing the things at any possible way. So the tax pressures, GST and all that, and the difficulty is that we pay the GST and we do not get the input credit for that, because this liquor is not a GST item. So we pay the GST and we do not get it offset by the selling. So it impacts the industry a little more than the other industry. But we are maintaining the highest profits in the sector. All our peers, we are doing a very good profit, and this trend will continue on the basis of the scale. We will be able to tackle this margin issue, and our profits are going to be in the same range of about 13 to 14%.
Just also understand a little bit about your QIP plans that had been proposed, about 200 crore rupees, and that was cancelled because there were lesser bids received. What was there any valuation concern? If you could just clarify for our viewers, and what is the update there?
Yeah, you see, company is doing exceptionally well, and company has got a very good internal accruals. We have done the expansions last year in all three units on the strength of the company's own accruals, and having completed all the expansions, still we have reduced the debt burden of about 100 crores. Our interest cost has gone down and this thing, and still we are having a lot of cash accruals with us. So company is not in any position of any immediate threat to its resources. But their investors were asking, say that you will not putting the conditions and all that you will not this thing. We see we cannot compromise with our plans. We have a definite business plan to grow, and that company is growing accordingly. So we thought, let us withdraw at this point of time, and we'll do it at the right time, maybe 6 months down the line, or again whenever board feels it's appropriate.
So just wanted to ask, given that you're saying that, then what about the capacity expansion plans that were proposed to be financed by the QIP? You are adequately financed in order to go ahead with this? Are you going to be raising debt to perhaps finance these capex plans that were in place?
Yes. Our capex plan is already on. We have already ordered the Germany to whatever the expansion of this thing. As I said, we have very good cash accruals, and we probably will go a little more for debt, because debt we are already reduced. We have a lot of leveraging capacity on the debt side. So at this point of time, we feel that debt would be cheaper than equity for us. So we will have little more debt and the internal accruals, and all our expansion plans are on time, and we will complete it before March to take the full advantage in the first quarter of the next financial year.
So Aurora, on that note, we'll let you go. Thanks so much for speaking with ET now. In the meantime, in terms of the big gainers, there's GE Shipping, which is also perking up a good 4%. MRPL is higher. Sri Renuka Sugars, NBCC, Home First. These are some of the names which are doing okay. On the losing side, it's Delta Corp that continues to reel under pressure. DMart, Thermax, Safari Industries. These are some of the names that we are watching out for on the downside. Slipping into a very short break. Don't go anywhere. When we come back, we'll have more managements on board and we'll discuss their outlook and strategy.
Back with the market right here on ET now, and it continues to be in a bit of a limbo for the frontliners. In fact, even when it comes to the broader universe, seeing precious little. Do remember our chartists as well had advocated a hold recommendation on the Nifty as well as the Nifty Bank, and just checking in on some of those banks. Indices taking a backseat. We discussed that stock on the editor's radar just earlier this morning. Closely watching out for HDFC Bank with respect to the financial quarterly numbers that will be released later today. There's something like an ICICI Bank that's on the back foot. On the flip side, Bandhan, Axis, IDFC First showing you mild gains. And you can just to reiterate that point, talking about banks really taking the leadership, it could really come about from anywhere that we see one of the frontliners participating and taking the Nifty Bank higher.
See, logic says it should be HDFC Bank, but the problem with HDFC Bank is that you don't even have a single bear on HDFC Bank. I mean, it's difficult to find bears in Baikala Zoo than on HDFC Bank. It's actually that kind of a setup we are in. Everybody's bullish, everybody owns it. Now, whether you drown till your knees or drown till your neck or drown till your throat, I don't know, but everybody owns HDFC Bank. So where will the fresh buyer come from? And that, I think, is the challenge for HDFC Bank. Either it has to go through serious time-wise correction, which it is going. That will make the stock look really attractive, and the existing buyers will be tempted to add more purely because of price, or new buyers have to kick in, which unfortunately is not happening. And on institutional side also, everybody is so committed to HDFC Bank that they do not want to increase their commitment. So it's a time-wise correction or a new buyer which has to come in. The current setup is suggesting that new buyer is not there. So time-wise correction has already started. In a year when markets have hit a new high, they've done it minus HDFC Bank and minus Reliance. How interesting is that? Where is Reliance, by the way? This year also, I think must be similar to HDFC Bank. There you go, 6% down for HDFC Bank, 8% down for Reliance. Between them, there is a 25% weightage. So it's like saying that out of the 4 legs of the market, one leg, which is a combination of HDFC Bank and Reliance, that actually has not participated at all.
Oh, well, yes, these heavyweights haven't been participating at all, whether it's Reliance, HDFC Bank. Will the last quarter of the year be any different? Let's see where it really trends. But let's welcome on board the next guest on the show. We have with us Mr. Jitendra Mamtora, the Chairman and Whole-Time Director at Transformers and Rectifiers, joining us on the show. Mr. Mamtora, good morning. Let's begin by discussing the prospects that could emerge from the Ukraine rebuilding as well. Because, of course, we have the domestic order inflow, which has been strong, given the order inflow in India is good. But we are just trying to understand what could be the opportunity size for Indian companies if areas like Ukraine, etc., are getting built up again.
See, most of the companies, MNCs, whether in Europe or in America, they are fully booked. Like, in America, if you see, the delivery period they are quoting is for the 2028, not even 2025 or 26. Europeans are all booked for up to 2027. They are fully booked. Now, about the Ukrainian opportunity, we have been L1 there. We have participated in one of the tenders, which has been funded by one of the American giants, and also it is being getting evaluated by E&Y. So once the evaluation is over, they will. We hope to get the order. It's a good order, about $60-70 million order, and then with a good margin. And the delivery period is also very favorable to us, which we can really work with that. And Ukrainian, we have one more advantage that we had for the very large transformers, association with Ukrainian company Zaporozhye Transformer, with whom we supplied something like 32 transformers to Power Grid in that consortium participation. We supplied 20, they supplied 12. So we are quite conversant with their requirement, and they also know us very well about our capability and our quality.
Now,
and as I said, the opportunities are immense. Moreover, our product range is probably the biggest in the Indian market. We are the only supplier of transformers required for green hydrogen, for arc furnace transformers, for rectifier transformers required for different kind of uh, electrolysis processes like metal refining, making chemicals, etc. So they are all our customers, and they are also, the delivery part period quoted by the European manufacturers who are having the majority stake worldwide. The markets, European special transformer is covering almost like 60% of the world market. And we are going to be one of them in the coming years, 2 or 3 years. Now we have started getting orders from them, from the European OEMs for supply of transformers for various projects, including the projects for the green hydrogen. We are now supplying some transformer to GE USA for one of the green hydrogen project.
If you have to export to Ukraine,
Yeah.
do you think you will have to go through a third party, or you have capability and the necessary clearance to export directly?
See, we have the clearance for export directly, but we have participated through a third party, a EPC contractor in Poland, because that will take off the working capital requirement from us. They will be giving us the advance, and we will be getting our 100, almost like 90% payment before the dispatch. So we prefer to go with the EPC contractor rather than quoting directly, and we have been shortlisted by them. The offer is under evaluation by ENY, as I said earlier.
Okay, now specifically to India, given that right now the sector is going through an overhaul, at what cusp of business cycle are you in?
Sorry, say again.
No, let's talk about the India business, your main business. Given that the sector has gone through a big reform, new capacities are getting added, new alternate sources are getting added, how is your business positioned?
See, today our market share for the large power transformers is something like 15 to 16% of the total orders which have been placed by the various utilities. Moreover, if I talk about the future requirement, if you see, our per capita consumption of electricity is only 1200 units as against 6000 units in China. And if we, and at least we expect to be a country like China, whose power consumption is something like 6,000 units today. So in by 2030 or before that, we should be reaching that the 6,000 units per capita consumption of electricity by 2030. That means, today we are at 1200 to 6,000, 5 times increase in the requirement. And moreover, see, there are two type of requirements. One is by the rural sector, where it is going to be just like a light and a fan. But the middle class is coming up very fast, whose requirement will be for the air conditioners and refrigerators, etc. So, that is going to increase the requirement of electricity very much. And beside that, we are, everybody is talking about the green energy, and we are one of the major player in the green energy sector. As today, most of the orders which are placed for power evacuation by the solar plant or solar projects, they are buying almost like our market share there is almost like 40% now. We are having order book only from power grid to the tune of 800 crores or more for the reactors as well as the transformers. We are one of the 5 companies in India who is actively involved in the supply of this large power transformers for evacuating power from the solar field to the grid.
I just wanted to get in a sense from you then, apart from Ukraine, which you have spoken about as an opportunity, what about the other export opportunity that you see, the kind of tenders that you have bid? Have you received any orders from the 3,700 odd crore tenders that you've bid? What is the opportunity in the likes of the US, Europe, in the US region as well?
See, the orders, I mean, or the tenders where we have participated to the tune of 3,700 crores has been said by my team. We have not, we have not participated so far in the tenders for the utility business anywhere in the world, but we are focusing more on the special transformers. Like recently, we got the order from GE USA for supply of transformers for the green hydrogen. We received some transformer orders from European OEMs for the supply of transformers for the various projects worldwide. So we are supplying to the OEMs, and that is where we also want to focus, because where the margins are huge and there are not many suppliers for those kind of transformers. Like in India, we don't have any supplier who has a track record or who has a reference for supply of rectifier transformers or transformers for the arc furnaces or for the green hydrogen. So we are one of the only one in India today with the references.
So you're the only one in India with the references, but what does all of this mean for your revenue and margins going forward? FY24, FY25, what kind of growth and revenue numbers should we pencil in?
See, as a matter of fact, we total have a capacity of something like 36,000 volt MVA, and there what we are doing now is we are trying to reduce the cycle time for the processes so that we can deliver more number of transformers with the same infrastructure. So we have done that, for just to name one project where we are taking something like 42 days. Now we are taking 33 days, and our target is to reduce it to 26 days. So once that happens, our capacity will just be almost like increased by 30-40%. So this is what we are looking at, and we are also looking at, as I said, for the special transformers for the green energy, whether it is hydrogen or whether it is arc furnace, because everybody is now talking about the production by using the green energy. So that is where the solar comes, wind comes, and that is where our transformers for evacuating the power to the grid comes. And as far as the 24-25 outlook is concerned, with the today's pricing, whatever is the price today, I think that my capacity will be, or I will be doing something like 40% more than what we are going to do this year, at least 40% more at today's price. But as we see that the prices of the transformers are going up, raw material prices are also going up a bit, and our margins are also going up. Like last year, we did with a what should I say, the factor of 80% raw material, 79% raw material. Today we are quoting, or the orders which we have, we are quoting at 72% raw material, and now we are quoting at 65-66% raw material price. So that will give us the bottom line very well. Beside the top line increase, the bottom line is going to increase even at today's prices.
Okay, on that note, we'll let you go. Thank you so much for joining us, Mr. Mamtora. In fact, on that note, we'll slip into a very short break. Don't go anywhere. When we come back, we discuss with Mr. Lal of Dixon Technologies as to what's the way forward, and more importantly, what's happening with the flip-flop around the laptop import ban, etc. Be right back. Welcome back. As promised, Mr. Atul Lal, the Vice Chairman and MD at Dixon Technologies, is with us on the show. Atul, hi, good to have you, and thanks so much for making time. We understand that company has entered into an agreement with Xiaomi for the manufacturing of smartphones and related products as well. Of course, you've had this partnership with Xiaomi over a long term as well, but talk to us about this one. When does the manufacturing start? Do you need additional investment? What could be the potential revenue accretion?
Xiaomi has been a long-term partner. We have been servicing Xiaomi requirement in the space of consumer electronics for almost 5 years now. So undoubtedly, this is a big win for us. This is mainly for smartphones, 4G and 5G phones, for which a new factory has been set up. The final investment in this plant is going to be almost 400 crores. This factory has been set up in Noida. The trials have started, and we are expecting to start the commercial production by end of this month or sometime in the next month.
There seems to be a clear change in narrative. Anything made from China is not accepted very well. Chinese brands are not getting that kind of in recall. The fact that you are now making phone for Xiaomi, what does that mean?
Well, we are of a firm conviction that the electronic goods in India and also for the global markets are going to be manufactured in India. So that undoubtedly has played out well in the last 4-5 years because of evolving geopolitical situations and also the Indian industry acquiring a certain level of maturity and the policy framework of the government, which has been extremely positive. So also the next firm conviction in Dixon is that more and more brands are going to be in an outsourcing mode. So in Dixon, we are purely an outsourcing company. We provide electronic manufacturing services to all the global and Indian brands. And the brand that you are mentioning undoubtedly is an anchor customer of ours. And we feel that the relationship will keep on deepening and growing. So we are country agnostic. We are any brand agnostic, wherein we see a huge leverage of growth and deepening of relationship over a period of time. We jump at it. And that's how this deal has broken it.
In terms of a specific news update, 3 months ago, there was an indication from the government that they would be coming out with a restriction on import of laptops. And I distinctly remember we had a conversation with you where you said that, look, it's not going to, it's big business opportunity for us and we don't have to invest a lot in order to make laptop manufacturing assembly lines. But looks like that entire thought of having import restrictions on laptop is on a back burner. What do you think it means for the sector and what do you think specifically means for you?
So the government very prudently has said that they're going to be slow on restriction part. But undoubtedly, there is a significant nudge from the government that the IT products being sold in India should be manufactured in India. And I feel that nudge has played out well. In our case, some of the large global brands are in discussions with us and we have had some major wins. Now, what the global brands are also looking for is that there should be a very solid business case for them. That means the cost at which they're sourcing their notebooks from China or elsewhere, it should be available to them at a similar price. Also, the other deliverables like quality and flexibility should be of a similar order. So we have committed and we have made some wins. Our investment plans and our target revenues in this particular domain stands the same. We have a large relationship with a Taiwanese brand, and we have just won a very large relationship with one of the top 3-4 global brands, and the manufacturing is going to start in a new plant in next 4 to 5 months. So for us, it stands the same, and we are committed to PLI 2. We have submitted our application. We are optimistic that we're going to be one of the beneficiaries under a domestic hybrid category under the PLI 2. So for us, the domain remains as exciting as it was 2 months back.
Could this be? I mean, could this potentially add 15 to 20% additional business opportunity for a company like Dixon if laptop manufacturing moves in India?
We feel so.
In the categories which you currently are in, mobile phones, consumer electronics, where do you think the growth is the highest and where do you think growth is now slowing down?
So undoubtedly for us, the biggest trigger of growth is going to be mobile phones in the forthcoming fiscals, and also the new opportunities of IT products. Further, our commercial production for the refrigerator plant is about to take place in the current quarter. So these are all triggers of growth.
But given all of this, are you expecting any big shift in the sales mix? Because if I have it right, right now, mobile is almost 45% of your business. Given you're expecting further growth there, is it likely to even inch higher then?
It's going to be higher. It's going to be the largest piece in our business.
Above 50%, what's the target you have in mind? And why not look at increasing, let's say, home appliances, which right now is just 9%?
So home appliances at present is in washing machines. In washing machines, again, we are the largest outsourcing company in this space. And in home appliances category, the new plant, as I just shared for refrigerators, is on the anvil. The trials are on and the commercial production is going to start in the current quarter. So again, it's a large capacity of 1.2 million refrigerators, which has been installed, which is almost 12-13% of the Indian requirement of DC refrigerators. So we have a large play. Similarly, in washing machines, we have a capacity now of 3 million machines, which is almost 30% of the Indian requirement. So we have a large play in appliances.
Okay. Next 3 years, if I'm hypothetically having a conversation with you on the same forum, this is 2023 October, 2026 October, what do you think we are likely to be discussing?
I hope you should be complimenting us that time of turning Dixon into an engineering powerhouse, where in electronics, various Dixon-powered design solutions across consumer electronics and appliances would be coming out from our stable, apart from the financial growth, of course. So the whole aim and the focus is to turn Dixon into an electronics engineering powerhouse.
Always very inspiring to talk to you. I mean, I've had the pleasure of tracking Dixon for years now, ever since it's gone public. And it's remarkable the way you've really forged from an unknown brand to an unforgettable brand now. So really appreciate your time. So glad you could join us on ET Now.
Thank you so much. And for these encouraging words. Really appreciate it. Thank you so much.
All right. Now, if you're wondering that it's time to reboot your lifestyle and trading hours would be extended soon, well, soon is the word which you would like to cancel out, because Ankur Mishra, my colleague, has learned from sources that the regulator has not taken a firm view on how soon the exchanges would be given the permission to extend the trading hours. Now, it's not a no, but it is not a yes, and it may not be a yes for some more time. Why? Well, let's go across to it.
Yes, sources say that market regulator SEBI is going to have consultation with market participants before giving go-ahead to trade time extension. The regulator is going to check what is the preparation on risk, what is the preparation as far as settlement is concerned, and also the preparation on manpower, among other checks and balances which regulator is going to apply before considering the trade time extension. Remember, NSE, after claim to have discussion with the stakeholders, has sent a proposal to SEBI for an extended session from 6 p.m. to 9 p.m. in the evening, and that was proposed in the F&O segment in the indices only, so that the traders get a time and opportunity to trade and react to the global events if they want to. So this proposal was sent to SEBI, and after that there has been several questions which has been asked by SEBI to the exchange, and that process is continuing. But before giving a final go ahead for trade time extension, SEBI is carefully examining the proposal. It is going to have consultation with all the market participants before moving ahead with the proposal.
Okay, at least for some time you can plan your evening still, and there's not going to be an extended hour, because all of us here were definitely worried that yes, there's going to be more news flow, but that will mean more work and you'll have to track a lot more news flow given the F&O trading was going to be extended, but at least not in the very immediate term. Some breather there, but is it going to be a breather coming in from HDFC Bank? The Q2 provisional updates were out and they were quite strong at that point of time. We had seen the stock was reacting 2 to 3% higher, but what will be the final number? What does the return on asset look like? What is their other internals in terms of asset quality? We'll try and get Harsh on board to talk to us about the expectations, because the earnings are expected later today. Harsh, tell us more about that.
Right, HDFC Bank will kick off earnings for the banking pack Q2 FY24. It's going to be a unique one because HDFC Bank is now a merged entity, HDFC Limited plus HDFC Bank, both loan books combined, and therefore the numbers will appear combined, and the percentages therefore may not be comparable versus last year or last quarter. So let me start off first with that net interest income number expected around the 28,500 odd crore mark. That's where it's expected. Where operating profit is concerned, around 23,000 crores. So we're expecting quite an elevated OPEX this time around as well from HDFC Bank as they continue to invest in branches. Let's talk about provisions expected around 3,100 crore. Now, mind you, provisions last quarter were around that 2,850 odd crore mark. So you add up the HDFC Limited provisions and roughly you're arriving at a 3,200 crore number. That's where we are getting the number from, and profit after tax is around the 15,000 crore mark is the expectation. 14,800 is the number as per our poll. Of course, the most important piece of the numbers will be how net interest margins are evolving. NIMs are expected to retreat a fair bit. In fact, the overall NIM, which was at 4.1% in Q1, is expected to be around the 3.7% number. That's the guidance. Of course, need to wait and watch out how it actually plays out. The other piece or the monitorables will be with regard to how ROAs are going to move and how quickly can they move to that 2% number, and whether that loan growth of 6%, 5% odd sequentially is really sustainable. Of course, deposit growth also very solid from HDFC Bank. Whether those numbers are sustainable or not is going to be the key with regard to where management commentary is concerned.
All right, now Shantanu Chakravarti joins us. Let's take our conversation forward. Represents PNB Paribas. Shantanu, good morning. Thank you for joining us. First, numbers from the combined entity. Given that what they've already indicated in terms of their analyst day 4 weeks ago and their quarterly update 2 weeks ago, are we in for pretty much an extension of what we know, or there could be some surprise?
I think given the amount of granularity and details they've given out, Nikunja, I mean, this quarter, the number to surprise one way or another too much would be very hard. Because if you think through it, we know exactly what the loan composition looks like at this moment. We know what the deposit composition has been. There have been clear guidances on what operating costs look like. And let's face it, this is not a part of the cycle where credit costs can really move the needle. In any case, it doesn't ever do much for this bank. Whatever little negative surprise there was on non-individual loans of the parents' asset quality was again, in the analyst meet only full clarity was given on that. So, I mean, this is not a quarter where the numbers in itself could swing one way or another too much, in our opinion. It's going to be a quarter where the commentary is going to be watched very, very closely as to what is the timelines that they commit in terms of achieving, a certain level of CASA, cost to income, ROA and margins. And that's what will be key out here, the trajectory and the timelines, not so much the numbers for the quarter. In some sense, the quarter is almost penciled in.
I'm yet to find a bear on HDFC Bank. Even though the stock has no bear, the stock is underperforming. Is it largely because of this whole over-ownership issue?
I think before attributing a reason, while it is true that at some level, most people are bullish on HDFC Bank, once you get into relatives within the prominent parts of the banking sector, which is, say, the ICICI versus HDFC debate, for example, you'll see two clear camps where one prefers one over the other. Now, people of the opposite camp are not necessarily negative on the other name, but relative outperformance-wise, people have very different opinions. Now, from time to time, we have had what the points that you're alluding to, the first we had that issue around MSCI selling, then the amount that domestics have to sell, and all of these technical factors are in place. But every time I look at the total trading volume of HDFC Bank under the current amount of free float, it is very hard to think that this could be anything more than minor squiggles in the short term. I think at some level, maybe dwindling amount of foreign flows would have played a role. But we wouldn't want to belabor that point too much. As far as fundamentals are concerned, we think that once we have a situation where that 2% ROA or even a 1.9% ROA achievement is clear in the parts of the market, it's going to re-rate upwards from the valuations it's at. Nikosh, this is a stock which is now at, if you strip out the valuation of the subsidiaries, it's trading at 2.2, 2.3 times 1 year forward core price to book. As you know very well, that's about 40% below where it used to trade. And if ROEs go back to being 17%, right? I mean, it's very hard to see how the stock will not re-rate. And that's why I prefer it as my top pick. It's not that I'm negative on the other two names. It's just that I'm a little more positive here, and this is a little bit more of a re-rating story vis-a-vis the others.
For the first time, we would be looking at HDFC Bank plus subsidiaries. We've always analyzed HDFC Bank for its banking business. How does that change the matrix? Because there are certainly a lot of moving parts now. The AMC business, the insurance business, the securities business was part of it, but largely it's insurance and AMC.
So, I mean, if you look at prior experience of looking at HDFC parent, for example, HDFC parent's valuations actually derated. If you go back in history, from the point in time that the EBLR and before that, the base rate regime went out and you had to do MCLR based lending, which at some level changed the competitive dynamic of the mortgage industry. And especially in a situation where HDFC parent was drawing a lot of fixed cost liabilities, that made it introduced certain asymmetries into their margin profile. So what was earlier a secular margin business to an extent became more cyclical. That's where the derating came in. Before that also they had substantial subsidiaries, but nobody made an argument around holding company discount at that point. It's only when the core business started to derate that a number of alternative narratives seem to have emerged. Similarly, when I look at HDFC Bank's subsidiary set, I don't see a business out there which can make a demand on the excess capital returns that are generated for the core bank. It's not as if there's a weak business out there which needs the financing of the successful bank. So in that scenario, to justify a very large holding company discount, to my mind, is a bit of a stretch argument and probably is influenced by which side of the debate someone stands on. Because the argument around whether similar levels of promoter interest are there across the various subsidiaries, and also in terms of whether the subsidiaries themselves a strain on excess resources. On both of those counts, the fundamental argument doesn't really stand. Can people have a preference for a pure bank play? To an extent, yes. But if that preference goes into any large discount territory, clearly that is arbitrageable.
All right. Shantanu, hi, morning. Also wanted to know what your outlook is on BOB with respect to the halting of customer onboarding. What kind of implications do you believe that this will have in the long haul?
As for the larger PSU banks are concerned, we expect performance to remain fairly steady on the key parameters, which is essentially credit quality as far as margins and as well as growth. And early releases point to that. If I look at the overall system growth number, and if you just do some balancing arithmetic, that also tells you that, especially for prominent large PSU banks, that should be in place. As far as the specific name you're mentioning, it would be hard for me to comment on that because currently it's outside our coverage list.
The view with a lot of banking experts like yours is that the NIMs have peaked out. And there's a report which hit our mailbox on Friday from UBS where they've talked about a downgrade on SBI. Is there merit in assuming that the freebie which PSU banks got largely because of NIM expansion that is over, and then FY25 onwards, the curve of growth is going to be south rather than north?
No, see, two things we have to keep in mind. Overall, the PSU system growth has lagged the private system growth in line with several years of trend. So if I look at, for example, SBI pretty much has been growing at what system credit has been growing at. And I would argue that more of the re-rating has actually come from emerging situation on both credit costs and confidence on extent asset quality, rather than a pure margin play. Because none of the larger PSU banks, frankly, have a very weak liability situation. They are still reasonably high CASA, one of their legacy strengths. So I think the dramatic change in the outlook and prognosis for these banks has been around credit, not around margins. So from here on out, until the credit cycles stays strong and you don't see any event-driven blow-ups in such banks, I think they will, the key narrative around such banks is going to be one of emerging and extant quality of credit. In fact, if you look at the current commentary around these banks also, what are people trying to focus on? They're trying to figure out what is happening in NBFC adjacent segments, what's happening in CVC, MSME, what's happening in unsecured lending. What are those telling us? People are trying to basically figure out if the asset quality can hold. I think that will continue to remain the make or break. Because remember, if in any negative surprise pans out in these cases, you have a high leverage and you'll probably need a capital raise at a valuation situation which is not ideal for you. So we have to keep that outcome in mind.
On that note, we let you go. Appreciate you joining us on ET Now. But it's time now to bring you an ET Now exclusive. We learned from reliable sources that Cipla's promoter group is likely to meet this week to iron out the differences, because that story is something as well which we brought to you exclusively earlier, that there were some roadblocks which were there in the deal making because of the valuation differential that the promoter family was asking versus what they were getting. We have our colleague Anurag Joshi joining us, who's been tracking the story very, very closely. Anurag, tell us what's the latest development.
So the promoters of Cipla are likely to meet this week. This is a very crucial and a key meeting ahead of a proposed stake sale by the promoter group. And now the Cipla's promoters are holding about 33.5% equity stake. Now, one of the key points I gather from sources is that they are going to discuss a clause which is the right of first refusal, which is in the shareholder agreement of 2017 among the promoters. And this clause makes it mandatory on any of the promoters who are looking to sell their stake to make a preemptive offer to the other promoters to buy the stake from them. Now, this comes amid differences among two factions of Cipla. So there is a majority faction, over 25% equity holding, which includes the non-executive chairman, YK Hamid. And there is a minority faction, which is about 8% of the holding, which is led by Samina Hamid. Samina Hamid is the vice chairperson of the company. Now, in the past, there have been prospective buyers who are looking to buy this stake, and and the key among them is Torrent Pharmaceuticals, which has put a non-binding bid and also has tied up financing for the transaction. So the buyers would be very keen to see, what the outcome of this meeting will be among the promoters.
So Anurag, it is really Samina and the shareholding which her family represents, which is where I guess a little bit of yes and no is happening, right, Anurag?
Yeah, right. And this is something, which the promoters, this meeting will, guide the way to show whether the promoters can patch their differences and can present themselves as a single unit, to sell the stake. And if, that does not happen, what are the eventualities, whether, there is a right of first of refusal clause which is exercised, and, who buys whose stake, and how does the stake sale go?
Anurag, thanks so much for joining us with that exclusive story. In the meantime, let's pull up some of the stocks as well, because there's finally some pickup, at least at the index level. We are now around that 19,750 thereabouts. Banking space still continues to reel under pressure, but it is IT which is actually doing quite okay. So you have HCL Tech, which is up a good 1.5%, and LTI Mindtree ahead of its earnings, which are of course slated for 18th October. That stock too has managed to gain a bit. Hero MotoCorp is perking up. On the losing side, it's Nestle, which is down. HDFC Bank too is under a bit of pressure. Just quickly marking a few more stocks from the broader markets. BLS International is up 7%. They just announced one of the tie-ups that they have done in Europe to add to their visa facility. So that stock is higher by 7%. You also have the entire mineral development space. So whether it's a GMDC, MMTC, GSFC, these all stocks are doing quite well for themselves. But slipping into a very short break, don't go anywhere.